Most traders believe they need a better strategy, a better indicator, a better entry, a better signal. But performance in trading rarely improves because of a new strategy. It improves because of better awareness, and awareness comes from documentation. This is where trade journaling changes everything. A trade journal is not just a spreadsheet, it is a performance mirror. It shows you what you are actually doing, not what you think you are doing. Because in trading, perception is often distorted by emotion. You remember the big wins, you remember the painful losses, but you rarely remember the patterns, and patterns determine performance. Let's break this down. Every trade you take contains data: entry price, exit price, position size, risk taken, time held, market condition, emotional state. Most traders only look at one number, profit or loss, but profit alone tells you nothing about consistency. You can make money with bad habits, and you can lose money while following your system perfectly. Without journaling, you cannot tell the difference. Professional traders do not track money first, they track behavior. They ask, did I follow my rules? Was my risk predefined? Did I exit according to plan? Was this trade aligned with my strategy? Because long-term performance is a result of repeated behavior. If your behavior is random, your results will be random. A structured trade journal improves your trading performance in 5 major ways. First, it improves clarity. When you write down why you entered a trade, you force yourself to think. You stop impulsive entries. You become intentional. Clarity reduces emotional decisions. Second, it exposes mistakes. When you review 50 trades in one place, you start seeing patterns. Maybe you overtrade on Mondays. Maybe you cut winners too early. Maybe you increase position size after a loss. These are invisible habits until you document them. A journal makes hidden weaknesses visible, and what becomes visible can be improved. Third, it improves risk management. Most traders believe they manage risk, but very few measure it consistently. Your journal should track average risk per trade, risk-reward ratio, maximum drawdown, win rate, expectancy. When you calculate expectancy, you understand if your system actually has an edge. Without this data, you are guessing. With data, you are managing a business. Because trading is not gambling, it is performance management. Fourth, journaling builds emotional control. Emotions destroy more accounts than bad strategies. Fear makes you exit early. Greed makes you hold too long. Revenge makes you overtrade. When you log your emotional state before and after each trade, you begin to see a connection between emotions and results. You may notice that trades taken in frustration have a lower win rate. That awareness alone can change your behavior. A journal does not eliminate emotion, but it reduces emotional blindness. Fifth, it accelerates improvement. Most traders repeat the same mistakes for years. Why? Because they never review systematically. Improvement requires feedback. In sports, athletes review footage. In business, companies review performance reports. In trading, your journal is your performance review system. When you conduct weekly reviews, you stop trading blindly. You begin trading deliberately, and deliberate practice creates growth. Now, let's address a common misconception. Some traders say, I don't have time to journal. But journaling takes minutes. Losing money takes months to recover. Time invested in documentation is time saved in correction. Another misconception. I already remember my mistakes. Memory is unreliable. Data is objective. If you rely on memory, you will justify your behavior. If you rely on data, you will confront it. And growth only happens through honest evaluation. Let's look at the difference between two traders. Trader A tracks only P and L. Trader B tracks performance metrics, mistakes, emotions, and rule adherence. Trader A focuses on money. Trader B focuses on process. Over time, Trader B improves consistency. Trader A rides emotional highs and lows. Consistency compounds. Emotion destabilizes. In the long run, process always beats impulse. Trade journaling transforms trading from reaction to reflection, from guessing to measuring, from emotional decisions to structured improvement. It turns trading into a skill-building discipline, not a lottery. If you want to improve your trading performance, start with documentation. Track every trade, review every week, measure your behavior. Adjust systematically. Because the goal is not just to make money. The goal is to build repeatable performance, and repeatable performance requires data. A trading journal is not optional for serious traders. It is foundational. Professionals track performance. Amateurs track profit. There is a difference, and that difference determines longevity. If you are serious about improving, start journaling today. Measure what matters. Review consistently, and build your edge through data. Download your free trading journals at decodedge.com. Track, analyze, improve.